Hey everyone, this is Mike Bonn with the Cash Flow Company. Today we're going to go over how numbers paint the picture. We all know what's happening with the Fed and how it's impacting us, but how does that really look when we look at the numbers? So we're going to look at some simple numbers and how the rates impact you as an investor, not only when you're looking at cash flow from rentals, but even on flips. We're also going to mix in how credit scores impact your rates because once again, these numbers are going to be impacted. The rates are going to be impacted by what you bring to the table with your credit score. So let's look at a simple example. Let's say you're purchasing a rental property. The purchase price is $250,000. So our purchase price is $250,000. And we're going to do a loan. We're going to put 20% down. We're going to look at 80% financing. I know there's other options when we look at 75 or 70, but in this case, we just want to keep all the numbers the same just to show the impact. So in this case, we're going to do a loan for $200,000 or 80% of what we bought it for. Now, to keep all the examples the same, we're going to say that taxes, insurance, HOA, all of those equal $300 just to keep it simple. Our whole goal here is to show you the impact of the rates based on credit, some other things, loan to value, and how it could either make you approved or declined or even cash flowing on the property. We're going to use DSCR as an example here because we're using rentals and it's one of the most popular products out there. It works the same for conventional and it also works on flips. The more you pay on interest, the less properties you could actually handle. So we're going to look at a property, loan amount $200,000. Let's start with a DSCR rate because we're doing 75%. Someone's getting for 9.75. That is high, but that's because our client only has a 680 credit score. Guess what happens if they have a 679 credit score? They're declined. Most dividing on 80% in this market for credit scores is 680. Anything below that is typically lowering your loan to value. So you're going to have to go from 80 to 75, which means you're going to have to put in more money on each purchase. So at 975, at the $200,000 on a 30-year loan, you're looking at a payment of $1,718. We're going to add the $300, and we're going to show that the payments monthly are going to be $2,018. One thing I forgot, when the appraiser goes out and looks at this property, they're coming back and they're saying the average rents and this area is only $1,950. If you understand the lending side, the DSCR or even conventional, rents are determined a lot on the appraiser and the appraiser's average of rents in the neighborhood. So if our appraiser comes back and says the rents are $1,950, that's what they're going to use in the underwriting unless you have a couple of years of history with rents over that. So you can see right here, properties, when rates keep increasing, are getting less and less likely to hit the mark, to hit the rents that are out there. If you're looking at a DSCR, this is going to either be a decline or it's going to flip you into a non-ratio DSCR, which means your rates are even going to be higher. Rates keep going higher, your payments are going to go higher, and your cash flow is going to suffer. In this case, it's going to be negative. So now let's look at the next break-even point, change it up here a little bit, and we're going to say the next person that comes in has a 720 score. The scores matter in credit. When you're looking at credit, it impacts your rate, and it's going to impact your credits, your cash flow in each property. So in this case, a 720 is going to get you about 75, 76 basis points lower, 8.99, meaning your payment is now going to be, the principal and interest is only $1,608. $300 means you're going to be paying $1,908. So credit, as rates decrease, whatever it may be, what you've found out now is a property that did not cash flow based on either credit score or just where the markets are, now cash flows. It doesn't cash flow that much, but it still cash flows. We're talking 1908, 1950. You have $42 at least in positive cash flow. Now, this property has a better chance of getting that DSCR loan or even a conventional because now we're getting into the cash flow. But you can see how it impacts it. The same property, rates going down either by credit score or just how the market goes, now makes this a cash flowing property. So number 3, let's look at if the rates even get better because either your credit score is higher or the rates just go down, how it impacts the profitability of a property. Let's say in this case, someone either has a 780 credit score or rates go down to not even that much, but 8.75. We want to look at realistic things that are happening in this market. Your payments now go down to $1,573 plus your taxes and insurance HOA. Now you're at $1,873. So what you're going to see is an impact not only on your cash flow, but your ability to qualify for a loan. Loans down here, the 1873, are easier to qualify, especially with DSCR, because it's positively cash flowing. Where up here, you're in the negative. It's the same property, same loan to value. Your rates impacted by credit or just the markets makes this property either affordable, cash flowing, or even your ability to qualify for a loan with this property. So as rates decrease, and they're happening, they've already happened over the last 3 weeks, and or your credit score goes up, or even better, your credit score goes up and rates decrease, opens up more properties to be in cash flow positive than they are right now. So we may be at the peak. We may be at the top where rates are high. They're going to start coming back. So some of these properties that did not cash flow, you're going to have to start watching them and see where they cash flow and where you could qualify now with that DSCR or get even a higher purchase price or pay a little bit higher purchase price as rates go down. I wanted to show you these numbers, paint this picture so you can understand and look at it. 3 different people coming in, trying to qualify for the same property can either be denied or approved just based on their credit score or where the markets are. I keep talking about leverage is king. This is what makes your wealth, creates your income, the leverage using banks' money, other people's money. You just don't want to overpay for it, but you also want to understand why things don't qualify, why the properties right now maybe are not cash flowing, and when they can start cash flowing. Because as you watch rates go down, those same properties are now going to become cash flow positive. Cash flow positive means there's going to be more properties available for more investors. So start watching that as the rates go down, but also start working on your credit. Get your credit as high as possible, so your rates as low as possible, which means it's going to impact your cash flow, how much you're going to make on each property. And as rents go up, you'll be able to capture more of that monthly income and create this income and wealth that we always talk about. I hope this helps. I hope it paints a picture of what's happening out there so you can see how rates are impacting the availability of rentals that are even cash flowing and what's going to happen in the near future as rates go down and we help you raise your credit score. Now, if you want to impact where you're at, where you're going to be ready for next year, check out our site, thecashflowcompany.com. We have a lot of ways to help you positively impact your credit. And we also have a newsletter that comes out. It's the Investor Mortgage Report, and it tells you where rates are going, especially in the DSCR in conventional loans. Are they going up? Are they going down? Are they staying the same? So if you want to be in the know and see where rates are, reach out to us, hit the contact us form, and we'll send that to you every week. If this helped, hit the subscribe button, hit the like button, and we'll catch you on the next video.